Welcome to the fireside chat between Yubi and Stenn on factoring and international trade finance. I'm Samarpita. I head offshore alliances at Yubi. With me, I have Annie Yadav. So, over to you to talk a little bit about Stenn and how it's really transforming this landscape in India.
So Stenn Technologies is a fintech company. We are headquartered in UK, London, and we have another US headquartered in Atlanta. We are very aggressively working on, supporting the suppliers based in India to, help them grow in their entire operations, to scale up their sales, to contribute, to their profit margins, and also help them to capture various different geographies and, expansion in real sense. Like you have at this moment of time, if an SME is dealing with say 5 suppliers, we our entire aim is to help him to reach to 15 or 20 in next 1 year of time. So that is what our main motive of Sten is. We are contributing by a single product, a very simple product mechanism, which is called export factoring, enabling suppliers trying to identify what their real problems are, what is the gaps, what is that they want to achieve, what their goals are, and hence completely dedicated to Indian suppliers and helping them to grow global.
Great, great. I think that really sets the context for the first question, which is really getting into the 101 of factoring or export factoring, like you put it. So, if you could just help the audience with the basic concept of export factoring and how it really it differentiates from the traditional financing methods in the market.
Sure. So, every exporter, like we all understand in an Indian financial system, we have got various different entities who are contributing by giving cash facilities or loans or credit facilities to the exporters. In India, everything is backed by some kind of collateral for the banks to assess the eligibility of the supplier. And also, there is a factor that the entire repayment obligation for any kind of loan or the borrowing that a SME is taking or an exporter is taking is completely on them. See, we all understand that every type of lender has its own USP. So, of course, primary lenders would be the banks because their cost of borrowing, there are many other factors. But what happens is when the exporter is hitting a stage in its life cycle and when he has got opportunity to grow, he can see that there are further more business opportunities. He is not able to capture them because of the shortfall and paucity of liquidity into the entire system. When we know that India is a supplier base, it's a manufacturing base. So the entire production cycle for any exporter is very long. I'm emphasizing on these points initially because we are trying to identify what are the real problems and real gaps. So when a small scale exporter is even getting an order from a buyer, which is good, one side he has to put in his cash and capital to get the raw material, then the production time, then the labor cost, and then when he's selling, it's already a very competitive market. To beat the competitive market and also to furnish the basic requirements of these international buyers these days to give them on credit. I come across, I mean, even if I talk to say 10 new exporters in a day, 9 of them share that their buyers are insisting on existing extended credit periods. It's not possible for them to make an immediate payment or advance payments. So they need to have some mechanism, some tool into their system where they can shorten the entire production cycle, where their leveraging can go low. That is when their margins will be there so that they can plow in the same into their system and also help them to negotiate better with the suppliers because then they have some fallback mechanism. When they go to any of the conventional banks, banks would ideally ask them to give in some kind of collateral, some kind of security for enhancement of limit, which is not ideally possible for an SME. Whatever he had, he has already pledged it. He's already given in his house, he's already given in his office, he doesn't have left anything. His receivables are pledged in. That is where, factoring companies like us come into the picture, where we do our entire assessment only on the buyer and not on the supplier.
Yeah.
We believe that supplier already is going through a lot of things. So how do we lessen his burden? How do we take out some burden from him and support him so that he reaches the next level? So, what at Sten we do is we go through the basic credit worthiness and whatever the information available of the buyer is there. We cover our risk through credit insurance. We go through whatever information is available. We have got lots of tools available into our system through which we assess and decide whether the buyer can be covered under our credit program, and we allot them a particular list. But from the supplier's end, we do not ask for any kind of security, any kind of collateral, any kind of underwriting. So factoring essentially is a mechanism where we pay a certain amount of invoice to this exporter immediately at the time of shipment once they have submitted the BL. We honor the credit periods that decided between the supplier and the buyer. Once the buyer makes a repayment to us, that is when we return the balance amount to the supplier. It's a simple mechanism where an exporter can realize its receivables earlier than what he is expecting.
Perfect. So I'm just summarizing the three key points that you mentioned. One is collateral free finance. One is absolutely it being non-recourse to the supplier. And third is indexing your credit due diligence on the buyer and not so much on the
Absolutely.
supplier, and really making it easier for the supplier, right?
Absolutely.
Great. So, in fact, I was also reading the FCI data, and it talks about how India has continuously been achieving double-digit growth when it comes to factoring, and that is both domestic factoring and international factoring, and especially post the COVID era. And essentially, FCI also strongly saying that the front runners of the growth in the coming years, when it comes to anything to do with factoring, in the South Asia and the Southeastern Asian countries, would be essentially driven by India and Vietnam. I think a lot of what you say really, sort of echoes with the trends that we are seeing in India. But if you have to summarize the financial, other than the operational aspect, the financial benefits that small exporters can expect by using factoring, that will be really helpful.
Sure. So I always come across these kind of questions from the exporters. Like honestly, whenever you talk about this product, exporter will come and say, "I already have facility from the bank. I already have a PCFC limit.
Yeah.
My buyer is ready to pay me in like 15 days. Why should I go for this facilities?" So I always try and explain them the crux behind a better and an efficient utilization of the tools that you have in the basket. If you
Mhm.
see from a promoter's angle, he might have like two, three, four options, and certainly he would not park all of that into one basket. Any businessman would think like that, because if one doesn't work, the other has to work. There's a similar formula which is applicable on this also. So what is the basic financial advantages to an entrepreneur, to an exporter of factoring? First of all, he is realizing his own money earlier than what his credit terms are decided with the buyer.
Correct.
The opportunity cost that he can do, instead of taking two orders, instead of taking one order, he can actually take two orders or three orders when he have that financial cushion. He doesn't have to park in any kind of hard collateral or intangible or a soft collateral anything for this facility, because the entire call and entire recourse and ultimate payment obligation is on the buyer.
Mm-hmm.
So his current banking, his current situation doesn't get affected at all. So if in 12 months, say in second quarter, an exporter is getting a sudden surge of inquiry, he's getting multiple orders from a buyer, he's getting new inquiries. At that moment of time, it is way beyond his projected fund requirement. What will he do? Either he forgoes and doesn't go to the business because there's no liquidity. Rather, he can come to companies like us and do more business, which increases its top line. This is one benefit. Second benefit is when an exporter is dealing with a new buyer, which is again a USP of Sten. They're
Yeah.
often very concerned about the geography, the geopolitical situation in that geography, the buyer's payment behavior, what is this going to be an approach. So this is one of the major key areas that our factoring companies contribute, because when we are doing an assessment on the buyer, we are doing a pre-check we are doing a credit insurance that itself gives a comfort to some extent to the exporter that yes, there is a third party, a neutral party who's not involved directly into the business. We don't know, say for example, we take up any industry, see, we take up an apparel industry. We
Mhm.
don't know how an apparel is manufactured, what is the crux going behind that. We are a neutral third party who is assessing a buyer, who is telling that yes, this buyer is doable and we will be able to cover your risk. So even if they come across some new geographies, new buyers, they can expand, they can do more business, which is not possible otherwise from a conventional financing institute.
Got it. Got it. Perfect. And if you were to summarize the key risk that exporters are able to mitigate through factoring, then what would those risks be?
See, as I covered, the new geography risk, the
Correct.
new buyer risk is one of the important things, and also, credit period is ideally starting from say 30 days, going up to maximum 120 days. There's a lot of things that can happen in 2 to 3 or 4 months of time. An
Right.
exporter, while taking up this facility, is at least getting 90% or 80% of the invoice value immediately at the shipment. So he himself has got the financing at the very first time. So that is one of the major risks because he is getting the money in advance. For him, the story
Yeah.
is over rather than waiting and going through any kind of uncertainty if possible.
Correct, correct. Now, if we cannot not discuss technology when we are discussing when UB and Sten are on the call because we are
Exactly.
tech first orgs. So at UB, other than obviously the network play of bringing the vast network of SMEs and exporters to the lenders, we really solve many inefficiencies through tech in the debt journey for our exporters. So a clearly by automating a large part of underwriting for our factoring lenders, and also various use cases of, let's say, invoice extraction through OCR, etc. But really wanted to hear from you. I mean, I know personally Sten is has always been the pioneer when it comes to tech. So how do you think technology is really changing the way export factoring is being conducted, and what are the innovative solutions that you're seeing in this space?
Yeah. Thank you for picking up that question, Samarpita. So we all understand that there are in India is a very regulated market with various different regulatory bodies involved into a cross-border transaction. May it be EDPMS, the banking system, the customs, DGFT, logistics, lot of things. From any exporter's point of view, they need to go through all of them. And though we have got good technology, but everything is separate. So there is a different process for DGFT, there's a different process for customs, there's a different process for EDPMS, that bank reconciliation, their own bank reconciliation. So there are multiple things, multiple portals and interface that an exporter any which ways have to go. And to top it up, we have GST as well.
Yeah.
So there are different things that an exporter is already doing. When we go to our banks, which are on the conventional way of working,
Mm.
however tech savvy we would want to, there is still a path that we need to reach there. So there is a lot of manual involvement into the process. There is a lot of paperwork and the time consumed, because when an assessment is made on the supplier, there are a lot of things that a bank or any financier would go through. They will go through their financials, their ITR, their GST returns, a lot of things. Whereas fintech companies like Sten, we believe in reducing the overall time, quick outcomes, and like instant credit facilities. Since we are, we are having multiple tools, and we have got an in-house tech team who has developed an amazing platform which has all the features of AI, OCR. So I will give you an example. On our platform, we have cases where if we have got complete information about the buyer, we have been able to give limits like in 4 hours of time. And from the supplier's point of view, it's only the KYC that we are doing. So ideally, if the information flow is correct, we are even in a position to complete a transaction in 24 to 48 hours. Now, ideally, the timelines are usually a little high. I don't want to put
Yeah.
up a very ambitious, but this is what has been possible onto our platform. So we believe in simplifying the problems, simplifying the processes, the least number of documents that should be involved into the process, and the shortest time that we can do. So when we have to discount a particular trade, we give a complete flexibility to the supplier, in terms of choosing which invoice he would want to discount. And we just need 5 documents, which are the basic trade documents to discount an invoice. We don't ask for any detailed interaction with the buyer. We don't ask for, so basically, we are eliminating all possible steps into the process, leveraging as much as on tech as possible to make the process simple, quick, faster, and easy.
Perfect. I think very well summarized. Thanks for that. I think one of the things that Sten and as heading sales there, you would be facing, and I think likewise, there's still a lot of lack of awareness about the whole concept of export factoring in small businesses, and how can that be addressed as per you, Annie?
So yes, there is a lot of there is a lack of awareness and lack of acceptance also.
Yeah.
Lack of awareness is one thing, and lack of acceptance is other thing. In India, we are a very culturally driven market, and we are a very close knit kind of a market. So if we talk about a certain industry, though they are having competition, they are in the same line of business, trying to snatch the buyers from each other. Still, they are very closely knit community. This is how our country is strong enough, and that's how it's always team. So I believe that every company has its individual requirement and ask. So exporters should be open. They
Yeah.
should look forward for different options. They should understand the application and use of a facility that's available to them. Comparing a particular facility to the conventional facility is not the right approach. I believe that exporters need to be opening up a bit. Like you cannot compare apples to pears and oranges to pears. So everything is different. We often come across this question: my bank is giving to me at a very cheaper rate. Why should I come to you?
Yeah.
This is the primary question that we all face. The problem is that it is all about the opportunity cost and the margin.
Yeah.
So if you have something which is a little expensive, but there is a huge amount of opportunity of business that is lying in front of you, you might be able to earn a little less margin, but it is certainly advisable. It is certainly making all the sense to do the business rather than saying no to the business completely.
Yeah, absolutely. I think the opportunity to, like I think you previously mentioned, right, scale up your orders, the opportunity to turn around that financing in a much shorter span of time at a lower cost without a collateral on your books, and most importantly, I think this is less realized, is the concept of non-recourse, right?
Yeah.
You really experience it when it really happens.
Yeah.
But the concept of non-recourse, in the factoring really sort of differentiates it, and a large part of that advocacy, a large part of that, sort of financial education in the most crude form, if I can talk about, in this space is also being driven by UB. When our client acquisition team, when our relationship managers really talk to all those borrowers, a large part of our time is really invested into explaining the product and how much it can really help these borrowers scale their businesses. So yeah, it's a very good point made. I think I'm down to probably the last two questions. If there is one advice that you would give to small and medium enterprise exporters, and why, I mean, you've talked a lot on a lot of the reasons why they should choose it, but the one clear factor that they should keep in mind while they should go for export financing.
So I would like to just keep it very simple and say that any growing SME or any growing company, I think ideally, apart from various other factors, need two things majorly: enough liquidity into the system and a strong negotiation tool. We Indians are very good at negotiations. Nobody can beat us in negotiation.
Absolutely.
So, factoring can be a very good tool. You would definitely find it a little expensive than the banks, but the exporters need to understand that we are giving a non-recourse, non-collateralized facility. It's the risk that we are taking. So whenever there is a risk, even if an exporter is taking a risk when they're dealing with a new buyer, their costing is going to be high. But when they have an established relationship for over a year or 2 years, then they know that it's okay, it's a constant business, they can reduce. So whenever there is something which is risky, will be a cost attached to it. So you cannot compare with the conventional, and use this tool as a very strong negotiation tool to beat and cut the competition. Somebody is giving 30 days of credit, you can simply offer 60 days of credit, 90 days of credit. Give comfort to your buyer. It's like any retail customer or a retail store that we go in. We know that when we are going to a luxury store, the kind of service, the kind of pampering that we get always helps us to step in again. It's the same thing when an exporter is giving all kind of flexibilities to a buyer. He automatically becomes a preferred supplier for the buyer. So use the tools that are available in the market smartly, and have optimum efficiency into your own system. Try it and see. There is a lot of flexibility, you can pick and choose, so that is it. But I'm pretty sure with help of UB, we will be able to spread this awareness to the deepest tier, where actually the manufacturers go through the requirement, where they do not have a lot of access to what is new in the market. Because we all understand, in metros, in grown up cities of India, there's a lot of advertisement, marketing, word of mouth, experiences of a customer who translate this. But with a strength of UV and companies like yours, we can actually enter the deep tier, which is the real pain point and where the actual requirement lies.
Absolutely. Thanks. Thanks. I think you've really summarized the key takeaway from the discussion. And thanks so much, Annie, for taking out the time.
Thank you so much, Samarpita.
Great having you.